Welcome to Business with Louis, the show where we explore the world of entrepreneurship and business concepts to help you succeed in today's fast-paced economy. I'm your host, Louis, and today we're going to dive into a crucial topic that affects us all: personal finance in an era of changing interest rates. In straightforward terms, personal finance in an era of changing interest rates refers to the management of one's financial affairs during periods when interest rates are fluctuating. This concept is important because it directly impacts our daily financial decisions, from saving and borrowing to investing and spending. Understanding how to navigate these changes can make a significant difference in achieving long-term financial stability and success. To grasp this concept better, let's break down its core principles and theories. The foundation of personal finance in an era of changing interest rates is built upon the understanding of interest rates and their influence on the economy. Influential economists like Milton Friedman have contributed significantly to our understanding of monetary policy and its effects on personal finance. Over time, our comprehension of how interest rates impact personal financial decisions has evolved, especially with the advent of more sophisticated financial instruments and digital banking. Historically, the concept of managing personal finances during changing interest rates has been around for decades, but it gained significant attention during periods of high inflation and subsequent monetary policy adjustments in the 20th century. Today, with the global economy becoming increasingly interconnected, understanding how to manage your finances through interest rate fluctuations is more crucial than ever. Let's consider some real-world examples to illustrate this concept in action. For instance, during the low-interest rate environment following the 2008 financial crisis, many individuals and businesses took advantage of cheap borrowing to invest in properties or expand their operations. However, those who failed to adjust their strategies when interest rates began to rise found themselves facing increased debt servicing costs, highlighting the importance of adaptability in personal finance. Another example can be seen in the success stories of investors who diversified their portfolios in response to changing interest rates. By including a mix of bonds, stocks, and other assets, these individuals were able to mitigate risks associated with rate fluctuations and capitalize on new opportunities as they arose. This strategic approach not only protected their wealth, but also positioned them for growth in a volatile economic environment. So, how can you apply the principles of personal finance in an era of changing interest rates to your own life or business? First, it's essential to maintain a balanced financial portfolio that includes both low-risk and higher-risk investments. This diversification can help hedge against inflation and interest rate risks. My colleagues on Wall Street often emphasize the importance of a well-balanced portfolio as a key strategy for navigating turbulent economic times. Second, building an emergency fund is crucial. Aim to save at least 3 to 6 months' worth of living expenses in easily accessible savings accounts. This fund will serve as your financial safety net when rates fluctuate and impact your income or expenses, providing peace of mind and the flexibility to make strategic financial decisions rather than reactive ones. Third, be mindful of the debt you carry and its terms. When interest rates are low, it might be an opportune time to consolidate high-interest debt into lower-interest loans or credit cards. However, when rates are rising, focus on paying down variable-rate debt as quickly as possible to minimize your exposure to increasing interest costs. Lastly, stay informed about economic trends and adjust your financial strategy accordingly. This doesn't require becoming an expert in macroeconomics, but having a basic understanding of how interest rates are influenced by monetary policy and economic indicators can help you make more informed decisions. For instance, knowing the signs of an impending rate hike can prompt you to review and possibly adjust your investment portfolio or debt obligations. As we conclude, remember that personal finance in an era of changing interest rates is not just about reacting to external conditions. It's also about making proactive decisions based on a deep understanding of how these changes can affect your financial health. It's akin to navigating a ship through changing waters. You need to know how to read the signs and adjust your course accordingly. In today's fast-paced financial environment, staying adaptable and informed is key. Whether you're a seasoned investor or just starting to build your financial foundation, understanding how to manage your finances in response to changing interest rates can make a significant difference in achieving your long-term financial goals. That's it for today's Business with Louis. Be sure to like, share, and subscribe. And remember, every great business starts with action. Make your next move count.